Alright, yo, what is up guys? Welcome back to another video. In today's video, we're going to be breaking down the best ICT silver bullet strategy, and we're also going to be providing you a full ICT silver bullet checklist and a risk management plan. So stay tuned, we'll be running through this quick and brief PowerPoint, and then towards the end of the video, we're also going to be going over a few trade examples that we took live inside the VIP signals room. Let's get into it. Alright, so let's start off with the complete basics, right? What even is the ICT silver bullet? Now, this is a trade that will usually occur every single day between the times of 10 a.m. and 11 a.m. New York local time. This is the silver bullet checklist. So number one, we are waiting for a sweep of liquidity, either buy side liquidity or sell side liquidity. Once we get a sweep of liquidity, the second thing on our list is a clear displacement. Okay, now this can occur anywhere from the 1 minute time frame to the 5 minute time frame. It can also happen on the 15-minute time frame. However, once we start going higher time frame, the stop loss placement gets a bit screwed and you're risking way too much capital. Hence, I've decided to narrow the time frames down to 1 minute and 5 minute as the maximum time frame you should be looking for a displacement on. Okay, the third rule is market structure shift. Okay, so if you're looking for shorts, you want to see a break below a swing low. If you're looking for longs, you want to see a break above a swing high. This is a valid market structure shift. Now, following this, you will usually get a fair value gap, okay, an FEG, which is an imbalance in price, and this is going to be where you will take your entry. This is one key component that a lot of YouTubers and influencers miss in their videos. Okay, you want to have your entry inside of the 950 to 1010 macro. Now, ICT does explain this in the 2022 mentorship. Now, the silver bullet hour is from 10 a.m. to 11 a.m. okay, but your entry will usually happen inside this 20-minute time window. And if your entry is not inside this 20-minute time window, that's totally fine. You can keep waiting. However, the probability of that trade working out is going to go down massively. The highest probability trade, you usually get an entry inside this 20-minute time window. Now, I have been backtesting and it is recommended to add 5 minutes before the macro and 5 minutes after. So instead of a 20-minute time window, it's actually a 30-minute time window. Okay, so just mark that extra 5 minutes in between on your chart. And if you do see the trade playing out at, let's say, 9:45, that's something that you can take. Okay, number 6, target the opposing liquidity. So this can be sell side liquidity or buy side liquidity, depending what direction you are trading. And lastly, you want to exit all your trades before 11 a.m. New York local time. Okay, so if you are holding any other positions at 11 a.m. and they still haven't hit your target, then you should be exiting your position. All right, so just a quick reminder, guys, the live VIP signals room is still available for only $50 a month. This is a Telegram chat where I send in trading signals for the NASDAQ, and we also go live on YouTube every single morning for the New York session. So you get to watch me trade live in front of you guys, and that way you can also learn from me rather than just taking signals blindly. Now, before I get into this week's results, we're actually running a 50% off sale for the lifetime access subscriptions. So prices are currently at $200 one-time payment. We are increasing these prices to $400 one-time payment within the next few days after this video is released. Go make sure to take advantage of that 50% off sale. But anyways, let's get into it. So Monday morning, we actually took no trade as it was very poor price action. Tuesday, we took a short trade that ended up running for over 45 points. Wednesday, we took a small loss of 25 handles. We actually got stopped out on this trade, and then all of our take profits got smashed. So Thursday, we ended up taking a short trade that ended up going for minus 15 points. However, we entered a short trade once again, and we actually smashed TP, securing ourselves 44.25 handles. Friday, we took another short trade that ended up being a break-even trade. We were literally a few ticks from TP1, but we got stopped out at break-even. Then we took another short trade that ended up smashing TP, 38.25 points secured. So as you can see, these are this week's trading results. I post one of these every single week, sharing the wins and losses, so all of the members inside can see how the group has done that week. Now, as you can see, this week wasn't our best week, but we still ended up in profit, securing ourselves a total weekly gain of 87.5 handles. Now, I'm going to keep it short here. If you are actually serious about getting your trading to the next level and you have been struggling with your trading and you want to come watch me live trade every single morning at New York Open, then I highly suggest that you go check out the link in the description and go secure your spot now for only $50 a month. And also make sure to take advantage of that 50% sale for the lifetime access. Anyways, let's get back to the video. All right, so let's go over the risk management plan for this strategy. Now, the max risk per trade idea that you should be risking is 25 handles for the Nasdaq, which is NQ, and let's say you trade S&P 500, the max risk per trade idea should be 5 handles. Okay, now if you have a live account of, let's say, 2.5k dollars, you want to be risking around 5 micros, okay, which is $250 per trade. Okay, so that is the amount that you are risking per trade idea, and it will take you 10 trades to blow that account. Okay, so you'd have to take 10 losses in a row in order to blow that account. Now, I don't know about you, but I've never taken 10 losses in a row. It's very unlikely to happen if you have correct management. Okay, now let's say you've gone the funded route and you've bought yourself a 150k top step account. In this case, you want to be using 3 mini contracts, okay, not micros. I'm using 3 minis, which is equivalent to 30 micros. Micros is 1 mini, okay, so that's 30 micros. This would be a total of 1.5k dollars per trade idea. However, with the top step account, every time you take a loss, you're going to half your risk, okay? So if you take a loss with 3 minis, you're going to go down to 2 minis. If you take a loss with 2 minis, you're going to go down to 1 mini. Once you get to 1 mini contract, you're going to stay there until you have your next win. Once you have your next win, you're going to increase your risk to 2 minis. If you have another win, you're going to increase your risk back to 3 minis, okay? Hopefully that makes sense. Let's say you want to be on the safe side, you're not comfortable risking 3 minis. Stick to trading 2 minis minimum. Okay, you take a loss, go to 1 mini and stay there until you win. You can go back up, you can increase your risk. Okay, there you go. That is your risk management plan. Very, very simple and straightforward. Now let's go over stop loss placement. Okay, very important. Given you a short trade example here, say we get that displacement and you get your fair value gap. Minimum stop placement is going to be above the displacement candle's high. Now, the displacement candle's high is the second candle, right? Fair value gap is a 3 candle formation. It's the second candle, right? So above that high, your minimum stop placement. You can also have a stop placement above a swing high. Now it all depends on the amount of handles you're risking. If you go back to the risk management plan and you see that your max risk is 25 handles, okay? Say the displacement candle's high, you're risking 13 handles, okay? The swing high, let's say it's 20 handles, all right? You're gonna wanna put your stop above the swing high, right? Because you have room for that. Let's say the displacement candle's high, risking 25 handles. Okay, that's the max risk. Therefore, that is where your stop is going to go. Now let's go over a long trade example. The exact same thing, but just the opposite. Okay, so minimum stop placement below displacement candle's low or below the swing low. Okay, very, very simple. Take profit placement. Okay, this is important as well. Minimum take profit is 25 handles on Nasdaq or a 1-to-1 risk to reward, and minimum take profit for S&P 500 is 5 handles or 1-to-1 risk to reward. Okay, I will not take profit unless the minimum take profit for that trade is 25 handles for Nasdaq. Okay, so let's say sell side is around 20 handles away. I'm not going to be taking that trade because it doesn't meet my criteria and it doesn't have enough handles for me to profit off. Okay, now where should you be taking partials? This is a great question, okay? So once again, we've got a short trade example. You want to be targeting a recent swing low, which would roughly equate to, let's say, 25 handles. And sometimes these recent swing lows can have 40 handles away from your entry, right? So if your first TP is at a recent swing low and it's 40 handles, great. That's a great trade. But the minimum for that trade, it has to have 25 handles for you to even take that trade. Okay, so once your TP gets hit and the recent swing low gets taken out, you want to close 50% off your position and you want to set your stop loss to the recent swing high, which is usually close to break even. Okay, so you've taken one contract off or 50% of many contracts you're trading and you're setting your stops to pretty much break even, and it's now a pretty much risk-free trade. Okay, same if you're taking longs, you want to target a recent swing high, close 50%, and then obviously set your stop loss to the most recent swing low. All right. Now let's talk about take profit 2s and final take profit. Okay, so after TP1 gets hit, you usually have a TP2 and a final take profit. Now I'm going to be explaining where you should be targeting and where you should be taking this profit off. So let's go over a short trade example. You want to be targeting 50% of the range, which is equilibrium. How you do that? You get your fib out on TradingView and you measure from swing low to swing high of that price range. Okay, another way is you can target an imbalance in a discount, so which is below 50%. That is a discount. If you see a fair value gap or an imbalance, that is a place where you can take your, let's say, take profit 2 or even final take profit. Okay, I like taking my take profit 2 at these levels, and my final take profits, I like to target an external sell side liquidity level or buy side liquidity level, depending on which direction you are trading. Now, some of you may ask me, what is an external sell side liquidity level? An external level is pretty much short for outside of the range, okay, outside of the price range. So This will usually be like a 4-hour buy side or sell side level, or even a daily, right? It's outside of that range, or even sometimes a 15-minute, okay? There's a ton of price ranges, so it's very difficult to explain, but I hope that makes sense. But yeah, that is pretty much your risk management plan and checklist. So I've covered where should you take profit 1, how you should manage your position once TP1 has been hit, where you should be taking take profit 2, and where you should be taking your final and last contract, which is your runner, to maximize that position. I've covered those topics. Now I would recommend to go back on this video, screenshot that checklist, and whenever you are about to place a trade, just go back and look at that checklist and see if everything adds up. So now that I've gone over this quick and brief PowerPoint, we're going to be jumping into some live trading examples on TradingView, where you can actually see this strategy being played out on the charts, and therefore it's going to be more easier for you to actually adopt this into your trading and learn it, as it is a very high win rate strategy, and it happens very often. Pretty much every single day you'll get some sort of setup that will happen between the times of 10 a.m. and 11 a.m. New York local time. Okay, so let's jump into that. All right, so we're going to skip straight to the 950 to 1010 macro. Now you want to mark this out on your TradingView chart every single morning. You can see an obvious buy side liquidity level here, and then all of this generated sell side liquidity down here. Okay, so first things first, off that checklist, we're going to be waiting for some sort of sweep of liquidity, either buy side or sell side. Okay, so let's see what happens. All right, so as you can see, we have taken all of these lows, this sell side liquidity, and we have left a swing high here, which is inside of this fair value gap. Now we're going to be using this as our market structure shift. So the second rule on that checklist is we want to see some sort of displacement higher, breaking through this swing high, which is our third rule, market structure shift. So let's see if we get those two things. All right, and as you can see, we get a clear market structure shift, a very clear displacement, which also leaves us our fourth step, just left our fair value gap behind. Okay, so this is where we're going to be taking our entry. Now I'm actually going to be dropping a small little gem for you lot. Whenever you have a swing high like this, which has been formed inside of a fair value gap, and this gets breaking through, that market structure shift is going to be higher probability, and it's going to be significantly more valid than a just normal market structure shift. Okay, and that is because it has been formed inside of this sell side imbalance, buy side efficiency. Okay, just a little gem for you lot. But anyways, we're going to be looking to be taking our entry off of this fair value gap. Now let's see if this is valid towards our risk management plan. Okay, so let's see, can I set my stop at the swing low, risking 25 handles? No, I cannot. I'm risking 63. So we're going to be going straight to the displacement candles low. Is it within side of our risk tolerance and risk management plan of 25 handles? Yes, it is. We're risking 22. Therefore, this is where we're going to be placing our stop. Now let's see if we get an entry on this trade. All right, so as you can see, we have had an entry on our long trade. We are inside of the 950 to 1010 20-minute time window macro. So everything on the checklist is so far adding up. Okay, where do I take my partial profits? Now, recent swing high. Okay, that is where your first TP is going to be. So your first take profit is going to be at 33.5 handles. This is where you're going to be closing 50% off of your position. And since this is an external buy side liquidity level, there will be no second TP, and we're going to be taking our final TP at this high here for 61 handles. Okay, so let's see how this trade plays out. Let's see if we can get TP1. All right, and boom, TP1 has been smashed. So I would have closed 50% of my position there, and straight away you want to set your stop loss at this low, okay, at this recent swing low, which is near break even. All right, so this is now pretty much a risk-free trade, and we're letting a few runners, 1 or 2 contracts, depending how many contracts you sold at TP1 towards final TP. All right, so let's see if we can get that. All right, so there you go. We don't not get stopped out, and we smash final TP, securing ourselves 61 points for that trade. Now, I actually wanted to show you another example, which is a short example, and this happened inside of that 10 to 11 a.m. New York time silver bullet hour. For this trade, we didn't actually get an entry inside of that 20-minute time window. However, it was very, very clear, and it still happened inside of that silver bullet hour, which is lower probability as you didn't get your entry inside of that time macro. However, it's still a valid trade, and it's something that we did take inside of the live VIP signals room. So as you can see, swept some sort of liquidity. We've taken this buy side liquidity level, and now we are waiting for a displacement and a market structure shift. All right, so there you go. We get that displacement. However, we haven't broken below a swing low. There's been no market structure shift, so I'm not taking this fair value gap. I'm waiting for more structure. I'm waiting for that market structure shift, and that is when I'll be taking my entry. There you go, right? We're respecting this bearish fair value gap as of now, and I'm waiting for more clear displacement to happen. We've broken below a swing low, we've displaced. I want to see my fair value gap to be taking an entry. Get a small, tiny fair value gap, right? It's not very clear, but it is still a fair value gap, right? Very, very small. Some of you might even miss this and not seen it. This is a valid trade. So you want to set your sell limit at the edge of the fair value gap, and you want to put your stop placement at the displacement candles low, right? This is within our risk tolerance. We're risking 22 handles, swing high 31, therefore we're going to put it at the displacement candles high. 22 handles, TP1, recent swing low, this is 22 points, okay? So minimum take profit is 25, so it's not going to be valid. We're going to be moving our first TP towards this swing low here for 37.75 handles, okay? So let's see if we get TP1. Alright, so we don't get stopped out, and boom, we get that TP1. Now, TP2, this is what I mean when I say 50% of the range, right? This right here is your price range. Now, you're going to measure from swing low to swing high, and this right here is 50% of the range. Where you can take your partial profits is either at this level, as soon as price hits equilibrium, or you can target some sort of imbalance or sell side, which is in the discount. Alright, so you can target this sell side here, or you can just target this fair value gap here, right? As soon as price enters that fair value gap, you can set your take profit too. So in this case, I'm going to be setting my TP2 at this low and see if we get it, all right? And then obviously, final TP is going to be at this external sell side liquidity level here. Boom, TP2 gets smashed. So at this point, you're setting your stops to 100% break even, right? So if price reverses on you, it doesn't matter at all. This is a fully risk-free trade now, and you're not risking any more capital. At this point, you're just leaving one contract to see if you get that final TP. Therefore, you're not risking a lot, right? You're leaving your runners. All right, so we actually get very, very close to that final TP. However, we don't get it, and we get stopped out for break even. Now, that's completely fine. This will happen in trading. You're not going to get final TP every single time, okay? Usually, you'll get TP1 and TP2, and then final TP you'll probably get around once or twice a week, okay? It doesn't happen every single time. So anyways, those are the two trade examples. Now, I've tried my best to explain it in a very simple manner for the beginners, and I hope that I've done a good job at explaining that. However, that is going to be it for today's video. If you have enjoyed this video, please leave a like, leave a comment, share and subscribe. And if you have learned something today in this video, please share your thoughts in the comment section down below. But anyways guys, I will see you lot in the next one.